have seen it 1,000 times. A single number, ticking up and down, second by second. A stock price. Fortunes are made and lost chasing it. Entire lives are shaped by which way it moves, and almost everyone assumes they know what it means. That the price is simply what the company is worth. But that is not really where the number comes from. The company does not set it. No expert hands it down. And there is no hidden, true price sitting out there in the world that you are somehow failing to see. The real answer is stranger, and once you understand it, you will never look at that ticking number the same way again. But before we talk about price, let us be clear about what you are even buying, because many people trade stocks for years without ever really knowing. A stock, a share, is simply a small slice of ownership in a real company. Buy one share, and you genuinely own a tiny piece of that entire business. Its factories, its brand, its future profits, a sliver of all of it is now yours. You are not buying a lottery ticket or a number on a screen. You are becoming a part owner. And that is the anchor for everything that follows. Because in the end, a share is only worth something if the business behind it is worth something. Everything else, all the noise and the motion, is just the crowd arguing over how much that slice is really worth. So now, what is the price actually? It is nothing more than this. The price of the very last trade, the exact amount at which one person was willing to sell a single share and another was willing to buy it. That is it. When you see a stock quoted at $100, it does not mean the company or anyone else has declared it is worth $100. It means that a moment ago, somewhere, two strangers agreed on that number for one small handshake. The price is not a measurement, it is a record. A record of the most recent agreement between a buyer and a seller, and the very next trade can change it instantly. But if price is just the last handshake, what sets the next one? Behind every stock sits something called the order book. Picture two crowds facing each other. On one side, buyers, each stating the highest price they are willing to pay. On the other, sellers, each naming the lowest price they will accept. The highest buyer and the lowest seller stare across a small gap, called the spread. A trade happens the instant one side agrees to cross that gap and meet the other. This is a live, never-ending auction, running thousands of times a second, and there are special players, called market makers, whose entire job is to stand in that gap, always ready to buy from you or sell to you. That small spread is their fee, their reward for keeping the market liquid enough that you can always find someone to trade with. So what actually makes the number move? At its heart, it is the oldest force in all of economics, supply and demand. When more people want to buy a stock than to sell it, the buyers must compete, offering higher and higher prices to tempt someone into selling. And up the price goes. When more people want to sell than to buy, sellers must accept less and less to find a taker, and down it falls. The price is simply the balance point, the single number where the pressure to buy and the pressure to sell meet for just an instant. Every tick you see is that balance shifting as the crowd's desire to own this stock rises and falls. Nobody decrees the price. It is pushed and pulled into being. And here is where it gets genuinely surprising. On any given day, only a tiny fraction of a company's shares actually change hands, often well under 1%. And yet, that sliver of trading sets the price for every single share that exists. Picture a company worth $200 billion. On a quiet afternoon, a modest wave of selling, just a sliver of the shares, can knock a few percent off the price. And in an instant, on paper, that company is worth several $billion less. Nothing changed inside the business. No factory closed, no product failed. A small handful of trades at the margin simply repriced the whole enormous thing. The price is set at the edge by the last most eager buyer and seller, and it speaks for every share that did not move at all. Now, this raises a puzzle. If a stock can be repriced by a small, moody crowd, then how does it ever reflect anything real? The legendary investor Benjamin Graham gave us the perfect image. In the short run, he said, the market is a voting machine, but in the long run, it is a weighing machine. In the short run, price is a popularity contest. It swings on excitement, fear, and headlines, all the votes being cast by the restless crowd. That is why a stock can soar or crash on almost nothing. But over the long run, something steadier takes over. Real earnings, actual profits. The genuine weight of the business slowly asserts itself. So price is two things at once, a moody vote today and a patient weighing over the years. There is another layer, and it surprises most beginners. A stock price is not really about the present at all. It is a prediction. When people buy a share, they are not paying for what the company earns today. They are paying for everything they expect it to earn far into the future. This is why a company losing money right now can be worth a fortune if the crowd believes it will dominate tomorrow. And it is why great news can send a stock down if that news was already expected and priced in. It is even why interest rates move every stock at once, because $1 of profit promised years from now is worth less than $1 today. The price you see is really tomorrow's hopes, dragged back into the present and quietly marked down by time. Now it gets almost dizzying. The economist John Maynard Keynes described the market as a strange beauty contest. Imagine a contest where you win, not by picking the face you find most beautiful, but by picking the face you think everyone else will pick. So everyone is really trying to guess what everyone else is guessing. The stock market often works the same way. To profit in the short term, you do not need to know what a company is truly worth. You need to guess what other people will believe it is worth tomorrow. This is why a stock everyone privately thinks is overpriced can keep climbing for months. Each trader thinks, yes, it is too expensive, but someone else will pay even more, so I will buy today and sell to them. Everyone plans to escape just in time, until one day the music stops and they all rush for the exit at once. This is where two great forces collide. On one side is the idea of the efficient market, the notion that all known information is instantly absorbed into the price. The moment news breaks, thousands of traders and lightning-fast algorithms pounce, and the price adjusts in a heartbeat. And much of the time, this works remarkably well. But on the other side is the crowd, and the crowd is human. It panics, it gets greedy, it stampedes. 400 years ago, a single tulip bulb in Holland rose to the price of a house before collapsing to nothing. The same fever returned with railways, with radio, with the internet. Each time, the crowd swore this time was different. The price is forever pulled between cool calculation on one side and raw, contagious emotion on the other. So let us return to the deepest question. Is there a single correct price for a stock waiting to be discovered? The unsettling answer is, not really. The price is not a hidden fact about the world, like the mass of a planet. It is something we create, together, moment to moment. It is a shared agreement, a kind of collective fiction that becomes real the instant we all act on it. The price is genuinely true in that you can buy and sell at it, but it is not fixed or handed down or waiting out there to be found. It is the living, shifting consensus of millions of hopes and fears, all colliding and settling for just one instant on a number, then moving on. So, if you are just stepping into the market, what should you actually take from all this? A few simple things that most people learn far too late. First, price is not the same as value. The number on the screen is the crowd's mood today, not the final truth about a business. Second, in the short run, the market is noise, a voting machine swinging on emotion. Do not mistake that noise for a signal. And third, over the long run, it is a weighing machine, and real earnings win. So instead of asking, will this number go up tomorrow, the far better question is, do I actually believe in the business I am buying a piece of? Think like an owner, not a gambler, because the crowd will always be loud and moody and afraid. Your edge is the patience to look past it. So the next time you watch that number tick up and down, you will see it for what it truly is. Not a verdict on reality handed down from on high, but the live negotiated agreement of a restless crowd, a moody vote today and a patient weighing over the years. And that understanding is quietly freeing, because you can stop searching for the one true price that was never there. You can stop mistaking the crowd's mood for the truth, and you can start asking the only questions that really matter. Not simply what is the price, but what is it actually weighing and what is it merely voting on? So let me leave you with this. If price is just our shared story about the future, how much of what you call value is real, and how much is simply what we have all agreed to believe? Tell me in the comments. And if you love seeing the hidden machinery behind everyday things, subscribe to First Principles Talk. We're just getting started.